everyone, this is Amit Pabari, founder and managing director of CR Forex. In today's presentation, we will discuss about trade deficit. Trade deficit is nothing but it is a difference between when a country imports more than its export. India का merchandise trade deficit जो था for the month of October came at $31 billion, which is a record highest monthly trade deficit since last 25 years. Now let us understand why this has happened. There are two major import items which we import as a country. पहला gold है, second है crude oil. Gold we import more than 95% of the gold what we consume in India, and crude we import more than 85% of what we consume in India. So basically in the month of October, because of festive season, we have seen that gold import was very high. Now if the trade deficit is increasing, generally the relationship between trade deficit and rupee is positively correlated. If trade deficit increase, generally अपना रुपया weak होना चाहिए. So is it a matter of concern right now? The answer is no. Why? Reason number one is gold import was the main reason why the trade deficit for the month of October was increased. Now we are expecting that as the seasonality demand will get over, gold imports will also reduce. Second है, crude oil price have fallen by 20% in last 20 trading session. So it is also going to reduce trade deficit. Third impact है, we have seen that exports have started picking up. So it is going to further reduce the trade deficit. Now let me show you an interesting data point. Generally when we are talking about trade deficit or trade balance, it is important that we see the entire picture. Goods pay, we are a net importer, but if we combine service into it, we are service trade surplus country, because of which if we compared for last year where the total trade balance was negative 90 billion, now it has reduced to $58 billion from a period of April to October. So technically we see that it is not a concern for rupee. Now let us discuss outlook for rupee. In last 2 weeks, most of the parameters have shown a clear-cut indication that rupee should appreciate in coming days. Dollar index fell from 107.5 to 103.5 kind of a level. 10-year US yield have fallen by more than 12%. Crude oil decreased by 20% in last 20 trading sessions. Apart from that, we have seen that Chinese and Japanese currency both have appreciated. Now let us see what kind of flows we are expecting. In coming days, we are expecting flows close to 1.5 to 2 billion in MSCI index flows. Based on all of these parameters, we can conclude that 83.30 to 83.45 is going to act as a very strong resistance for rupee, and in coming days, if 83 is broken, the pair will gradually move towards 82.50 and then 82.20 kind of levels. Now let us discuss strategy for thin margin exporters. Thin margin exporters like agri exporter, chemical exporters, most of them are taking costing between 83 to 83.20 kind of level. For them, we will suggest them that they should strictly cover their exports 80 to 100% between 83.10 to 83.30 kind of a level, because the overall outlook is that the currency is going to appreciate below 83 kind of levels. If anyone wants to keep it open, they should keep a stop loss of 83 or costing whichever is higher. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. From last 2 months, rupee has been on a weaker side, so there are higher probability that thick margin exporters can get complacent. But let me tell you, most of the parameters have given sell call. So it is important that you maintain a strict hedge ratio. If you are booking under confirm order basis, then you should hedge 80 to 85% of the exposure between 83 to 83.30 kind of level. If you are hedging against anticipation order, then maintain 55 to 60% of a hedge ratio. If you still believe that rupee can get weaker, then please keep a strict stop loss of 83. If 83 is broken, then please go and cover. Now let us discuss strategy for importers. It is very clear that the upside in the pair is limited. So ideal strategy for any importer is that they should not cover aggressively and they should not cover long-term imports. So what we are suggesting for importers is that for the next 15 days import, they should cover only 50% between 82.95 to 83.05 kind of levels. If any importers wants to cover aggressively and they want to cover 1 month and beyond, they should ideal cover via option. So if the pair appreciates, they can get an advantage out of that. Third strategy is that they should opt for suppliers credit between 83 to 83.30. So as we are expecting the pair to appreciate in coming days, they get advantage out of that. With this, I will end my today's presentation. जय हिंद है, नमस्कार है, फिर मिलेंगे नेक्स्ट वीक. थैंक यू.